Hey, welcome. Today, we're going to pull back the curtain on something that affects all of us every single day, how the price of, well, everything gets decided. We're talking about demand, supply, and this perfect balancing point called market equilibrium. So let's dive right in. You ever stop and wonder why the price of strawberries is so different in the summer versus the winter? Or what actually goes into the price of your morning coffee or that pizza you ordered last night? Well, believe it or not, the answer to all of that comes down to this really fundamental dance between buyers and sellers.
All right, so to get our heads around how prices get set, we've got to start in the place where all the action happens, the market. Now, I know what you're thinking. When I say market, you're probably picturing, a building, maybe a farmer's market with stalls. But here's the thing. In economics, a market isn't really a place at all. It's the process. It's the interaction, the exchange between anyone who wants to buy something and anyone who wants to sell something.
Yeah, sure. The New York Stock Exchange is a huge, famous example, right? High stakes, lots of action. But you know what? A market is also your neighbor's garage sale. It's that local farmer's market. Or it's a giant online space like eBay, where millions of buyers and sellers are connecting every second. It doesn't matter where it is. The key thing is that it brings people together to trade.
Okay, so every single market, no matter what it is, has two sides. You've got the buyers, that's you and me when we go shopping, and all of us together, we create what's called demand. And on the other side, you've got the sellers, the companies, the producers. They create the supply. And these two forces, demand and supply, they're literally the engine that makes the whole thing run. Okay, let's tackle this one piece at a time. We're going to start with the buyers, with us. And our behavior is guided by this really important idea called the law of demand.
So the law of demand sounds kind of formal, but honestly, you already know how this works. It just says that there's this inverse relationship between price and how much people want to buy. In plain English, when your favorite pizza spot has a 2-for-1 deal, you're way more likely to grab a pizza, right? Of course. But if they suddenly doubled their prices overnight, you'd probably, make a sandwich instead. See? That's the law of demand, right there.
And this isn't just a feeling. We can see it in the numbers. Check out this demand schedule for coffee. Okay, so look, at $5 a pound, people in this market will buy about 3,000 pounds. But watch what happens as that price starts to drop. Down, down. Look at that. When the price hits just $1, the amount people want to buy explodes to 8,000 pounds. It's a huge difference.
And the cool thing is, when you take those numbers we just saw and plot them on a graph, you get this, the classic demand curve. See how it slopes down from left to right? It's the perfect picture of what we're talking about. As the price, on the side here, goes down, the quantity people want, along the bottom, goes way up.
All right, so that's the buyers. Simple enough. But remember, they're only half of the story. Now we've got to flip the coin and see how things look from the other side, from the seller's point of view.
And for sellers, we have the law of supply. And this one is the total opposite of demand. It's a direct relationship. And again, this just makes sense, right? It's all about incentives. If you're a coffee farmer and the price of coffee is high, what are you going to do? You're going to work your tail off to grow and sell as much coffee as you can because you're going to make more money. But if the price is super low, maybe it's not even worth the effort to harvest it all.
And just like before, we can see this in the numbers. Here's the supply schedule for that same coffee market. And look, it's pretty much the mirror image of what we saw with demand. At a measly $1 a pound, sellers are only willing to put 1,000 pounds on the market. But when that price jumps to $5, boom, supply shoots up to 8,000 pounds. You can just feel the power of that profit motive. And you guessed it, when we plot these points on a graph, we get the supply curve. And see how this one slopes up? It's the perfect visual of that direct relationship. The higher the price, the more stuff producers are excited to make and sell. Okay, so now we've got these two powerful opposing forces. Buyers are pulling the price down, sellers are trying to pull it up. So what gives? Where does the price actually land? Let's find out. Let's find the market's sweet spot.
So on one hand, we have this downward sloping demand curve, that's all the buyers. And on the other hand, we've got the upward sloping supply curve, that's all the sellers. It's basically a big tug of war. So the million-dollar question is, what happens when we put them on the same graph?
While this happens, they cross. And they only cross at one single solitary point. And let me tell you, this intersection right here is the magic spot. It's the most important point on the whole graph. This is what economists call market equilibrium. It's that one price and one quantity where everyone, more or less, is happy.
And for our coffee market, that sweet spot, that equilibrium price is exactly $3 a pound. That is the one and only price where this market is perfectly balanced.
And here's why that's so important. At $3, the amount of coffee buyers want to buy, which is 5,000 pounds, is exactly the amount sellers want to sell, also 5,000 pounds. Everybody who wants to buy coffee at that price can get it. Every seller who wants to sell at that price can find a buyer. The shelves are cleared. It's perfect.
Okay, but we all know the world isn't always perfect, right? So what happens if, for some reason, the price isn't at that magical $3 point? Let's see what happens when things get a little out of whack.
So let's pretend the price is set too high. Let's say it's $4. Well, at $4, the sellers are thrilled. They bring 7,000 pounds of coffee to the market. But the buyers, they look at that price and say, no thanks. They only want to buy 4,000 pounds. So what do you have? You have a mismatch. You have a surplus. There are literally thousands of pounds of coffee sitting around with no one to buy them.
Crash Course Economics has a great way of putting this. Producers would like to produce a lot, but consumers won't want to buy them. And that's exactly it. You can just picture it, right? Bags of coffee piling up in a warehouse. And that puts a ton of pressure on sellers to do one thing: lower the price. They need to get rid of that extra coffee. And as they lower the price, where does it head? Right back down towards that $3 equilibrium.
Okay, now let's flip it. Let's look at the complete opposite. What happens if the price is set too low, say $2 a pound? Well, at that price, it's a party for the buyers. They want to buy 6,500 pounds of the stuff. But the sellers? They look at that $2 price and they're not so excited. They're only willing to supply 3,000 pounds. And now you have the opposite problem, a shortage.
A shortage means you've got empty shelves. You've got customers who want coffee and can't find any. And when you have a bunch of buyers all chasing after a very small amount of goods, what happens? It gives the sellers all the power. They know they can raise the price, and as they start inching that price up, it gets pushed right back towards that $3 sweet spot. It's like the market has this amazing, built-in, self-correcting system.
So there you have it. We've seen how markets, kind of magically, are always pushing themselves back towards this state of balance. It's what the famous economist Adam Smith called the invisible hand, always guiding prices back to equilibrium. But here's the final thought. That point of balance, it isn't set in stone. It can move, which leads to a really interesting question. What kind of powerful forces could come along and shift that entire supply curve or that entire demand curve and create a totally new reality, a brand new equilibrium price? Well, that's a story for another day.